As 2025 draws to a close, the retail world is looking ahead to 2026 with a sense of cautious optimism, but also a fair bit of uncertainty. Across Europe, shop owners, employees, and shoppers alike are wondering what the next 12 months will bring. Will the high streets bustle with renewed energy, or will the slow pace of recent years continue to shape our shopping habits? According to Deutsche Bank's latest forecast, the answer is clear. Expect muted growth for both UK and European retail. That means no dramatic booms or sudden recoveries, just slow, steady progress, with retailers working hard to adapt to changing consumer demands and economic pressures. The days of double-digit growth seem far away, replaced by a focus on stability and resilience. This matters more than you might think. Big investors and financial institutions use these forecasts to decide where to put their money, shaping which shops and brands will thrive and which may struggle to survive. Their decisions ripple through the entire retail ecosystem, influencing everything from store openings to product launches. For everyday people, the health of retail giants like Tesco or Adidas isn't just about shopping choices. It affects local jobs, the prices we pay for essentials, and the overall vibrancy of our towns and cities. When these companies do well, communities often benefit. When they struggle, the impact can be felt on high streets and in households across Europe. That's why understanding Deutsche Bank's outlook isn't just for city traders or financial experts. It offers important clues about the economic pressures shaping our shopping experiences, our household budgets, and even the future of our favorite brands. Whether you're a business owner, an employee, or simply someone who loves a good bargain, these forecasts matter. In this video, we'll break down what muted growth really means for the retail sector, highlight which companies are tipped for success in the coming year, and explore where the biggest risks and opportunities lie for both businesses and consumers. From the ongoing struggles of DIY stores to the latest supermarket technology upgrades, we'll guide you through the trends, challenges, and innovations shaping the future of retail in 2026. Stay tuned to find out what's in store for Europe's shops and for your own shopping experience in the year ahead. When we talk about muted growth on the high street, we're describing a retail sector that's inching forward, but at a pace that feels almost glacial. The energy and buzz that once defined shopping districts have faded, replaced by a cautious optimism and a sense of waiting for better days. Imagine a car stuck in first gear, moving, but never quite picking up speed. That's the reality for many retailers right now, as they navigate a landscape filled with uncertainty and shifting consumer habits. While we're not seeing a wave of mass closures, the competition among shops is more intense than ever. Every customer counts, and businesses are fighting hard to stand out, attract foot traffic, and keep their doors open. To survive, expect to see more frequent sales, creative loyalty programs, and aggressive cost-cutting. Retailers are working overtime to protect their already slim profit margins, often by innovating or streamlining operations. For investors, this environment is challenging. Gone are the days when you could simply ride the momentum of a booming sector. Now it's about precision, research, and careful selection. The winners in this climate will be those companies with a clear edge, whether that's a unique product, a loyal customer base, or strong leadership that can adapt quickly to change. Essentials and everyday items are likely to fare better, as people prioritize needs over wants. Deutsche Bank's latest report signals a shift in strategy. Instead of broad optimism, the focus is now on careful, calculated stock picking, where understanding the nuances of each business is crucial. Looking ahead to 2026, success will come from identifying individual stories of resilience and innovation, rather than betting on the entire sector to recover at once. Investors and business owners alike will need to dig deeper to find those hidden gems. In a sluggish, slow-moving market, the smallest details and the smartest strategies will make all the difference. Every decision counts more than ever before. 2025 saw huge gaps between retail's winners and losers. Some stocks soared, others slumped. At one point, the price-to-earnings ratio spread across retail stocks was a staggering 19 times, showing clear investor favorites. But Deutsche Bank warns, the top performers of 2025 are unlikely to repeat their meteoric rise. These stocks are now expensive, and chasing last year's winners could disappoint. Instead, investors should look for new opportunities and undervalued companies. The lesson? The easy money has been made. Now it's about careful selection. 2026 will reward those who dig deeper for value, not those who follow the crowd. The party for last year's high flyers is over. It's time to find the next success stories.
So, what's the plan for investors in this slow-growth world?
Deutsche Bank recommends a three-pronged approach: seek inflation beneficiaries, find companies with room to expand, and hunt for unique, stock-specific stories. Inflation beneficiaries, like supermarkets or luxury brands, can pass on rising costs and protect profits.
Next, look for retailers still opening new stores or expanding into new markets. Growth that's independent of the sluggish economy.
Finally, focus on companies with a compelling turnaround, tech edge, or niche dominance.
It's about resilience and unique advantages, not broad market trends. The best opportunities will be those with a clear individual story. In 2026, stock picking is king.
When looking ahead to 2026, Deutsche Bank's analysts have identified a handful of retail sectors they believe are best positioned to thrive, even as economic uncertainty lingers. Their top picks: premium discretionary categories like luxury goods, sporting goods, leading clothing retailers, and food retail giants. These are the segments Deutsche Bank sees as having the right mix of resilience, pricing power, and consumer loyalty to weather whatever the next few years might bring.
Take luxury brands, for example. Companies such as Watches of Switzerland cater to affluent customers who are less sensitive to price increases. This makes luxury retailers more defensive during economic downturns, as their clientele can absorb higher costs without cutting back on spending. These brands also benefit from global demand, with shoppers from emerging markets and established economies alike seeking out high-end goods as status symbols and investments.
Sporting goods retailers, think Adidas, are also in a strong position. The global health and wellness movement continues to gain momentum, driving demand for athletic apparel, footwear, and equipment. These brands have built loyal customer bases and have successfully expanded their reach across continents, making them less vulnerable to regional slowdowns. Their ability to innovate and tap into lifestyle trends keeps them relevant and in demand.
European clothing retailers like Zalando stand out for their scale and technological investment. By leveraging advanced logistics and data-driven strategies, they can serve diverse markets efficiently and adapt quickly to changing consumer preferences. This agility, combined with a broad product offering, gives them a competitive edge in a rapidly evolving retail landscape.
Food retail, with giants like Tesco, remains a classic inflation winner. No matter the economic climate, everyone needs to eat, and large supermarket chains are experts at managing costs and supply chains. Their scale allows them to negotiate better prices and keep shelves stocked, ensuring steady demand and stable margins even when times are tough.
What ties these sectors together is a combination of pricing power, growth potential, and resilience. They're able to pass on higher costs to consumers, continue expanding, and withstand economic shocks better than most other retail segments.
That's why Deutsche Bank is steering investors toward these strongholds, encouraging them to focus on areas of retail that can offer stability and growth, rather than riskier, more vulnerable corners of the market. In a muted or uncertain market, these sectors stand out as the safest bets for investors looking for both security and opportunity.
Not all retail sectors are equal. Deutsche Bank warns against DIY, discount retail, and UK-centric clothing.
DIY stores like Kingfisher face a post-pandemic slump as home improvement spending fades and inflation bites.
Discount retailers, despite low prices, are squeezed by fierce competition and razor-thin margins.
UK clothing retailers, such as Primark's parent AB Foods, are exposed to a crowded market and cautious consumers.
These sectors face strong headwinds, growth will be tough, and profits are under pressure. Investors should tread carefully here. In 2026, picking winners in these areas will be especially challenging.
Deutsche Bank's report doesn't just analyze sectors, it makes bold calls on individual stocks.
Kingfisher was downgraded from hold to sell, reflecting deep concerns about the DIY sector's prospects.
B&M, a discount retailer, was cut from buy to hold, with a sharp drop in its target price.
Wikis, another DIY player, was upgraded from sell to hold, suggesting it's better positioned than rivals.
The biggest positive? Sainsbury's upgraded from hold to buy, with a higher target price.
Tesco also kept its buy rating, showing continued confidence in big supermarkets.
These changes highlight Deutsche Bank's selective stock-picking approach for 2026. The winners and losers are shifting. Watch these names closely.
Food retail stands out as a safe haven. People always need groceries, making supermarkets defensive investments. Sainsbury's got a major upgrade, with Deutsche Bank raising its rating to buy and boosting its target price.
Sainsbury's Aldi Price Match campaign is winning back customers and driving sales, making it a turnaround story to watch.
Tesco, the UK's largest supermarket, kept its buy rating and saw its target price nudged higher. Tesco's scale and loyalty programs give it a powerful edge in managing costs and keeping customers loyal.
Both supermarkets are well placed to thrive in a slow-growth, high-competition environment. Deutsche Bank's message: big, established food retailers are the safest bets for 2026. In a cautious market, these giants offer stability and upside. Deutsche Bank's muted growth forecast is a roadmap for a careful, competitive year ahead. For investors, the era of easy gains is over. Precision and selectivity are essential. The focus shifts to resilient sectors like luxury and food retail, and to companies with unique turnaround stories. For retailers, expect fierce competition, aggressive pricing, and a relentless push for efficiency. Shoppers will see more promotions and loyalty schemes as stores fight for every pound. The struggles in DIY and discount sectors may mean fewer new stores or less choice in those areas. Ultimately, the companies that truly understand and serve their customers will quietly thrive in 2026. In this new retail landscape, smart strategy, not hype, will win the day.